A country discovers oil, billions of barrels beneath the ground, enough to transform the nation, build schools, hospitals, infrastructure, lift millions out of poverty. The contracts are signed, the oil flows, the money arrives. 10 years later, the country is deeper in debt than before the oil was discovered. The infrastructure is crumbling. The hospitals have no medicine. The schools have no teachers. The oil is still flowing. The money is still arriving. But somehow, the country is broker than ever. This isn't incompetence. It's not just corruption. It's a trap. A mechanism so elegant, so perfectly designed, that countries can't see it until they're already caught. It's called the dollar trap. And it works like this. To buy anything on the international market, oil, medicine, machinery, food, you need dollars. Not your own currency, dollars. So, you sell your resources to get dollars. Then you use those dollars to buy what you need. But the dollars never stay. They flow out immediately. And to keep going, you need more dollars, always more. You're not building wealth. You're running on a treadmill, and the speed keeps increasing. This is the story of how the dollar became the world's most sophisticated extraction mechanism, how it traps entire nations in permanent poverty, and how every country that tries to escape gets destroyed for attempting it. Woods, New Hampshire, July 1944. The war is still raging, but the victors are already dividing the spoils. 700 delegates from 44 nations gather to redesign global finance. The British send John Maynard Keynes with a proposal: create a neutral international currency that prevents any single nation from dominating world trade. The Americans send Harry Dexter White with a different plan. The dollar becomes the world's reserve currency. Every other currency pegs to the dollar pegs to gold, and America controls both. It's not a negotiation. America holds 2/3 of the world's gold. The U.S. economy is untouched by war. Europe is rubble. The world needs American money to rebuild, so the world accepts American terms. Keynes returns home defeated. His diary: we have sold ourselves into a system where America is the only banker, judge, and jury. The dollar system is born, and with it, a trap that will quietly drain wealth from poor countries for the next 80 years. How the trap works. You're Zambia. You mine copper. To sell it internationally, buyers pay in dollars, not Zambian kwacha, dollars. Because copper, like oil, wheat, and coffee, is priced in dollars globally. You get dollars. Good. Now you need machinery from Germany. The German company doesn't accept kwacha. They want euros or dollars. You convert dollars to euros, buy machinery. Fewer dollars. You need medicine from India. India wants dollars. You pay. Fewer dollars. You owe loans to the World Bank. Denominated in dollars, you pay even fewer dollars. Year end. You've sold all your copper, received dollars, but those dollars flowed right back out. Your reserves are zero. To keep the economy running, you mine more copper next year. Sell for dollars. Watch those dollars drain out again. You're not accumulating wealth. You're hemorrhaging resources to maintain dollar access. But here's the trap within the trap. When copper prices fall, you still need the same dollars for imports and debt, so you mine more, export more, just to stay in place. This is the commodity treadmill, and it's designed to run forever. Real numbers. Zambia, 2000. Copper exports, $450 million in dollars. Where it goes. Debt service, $180 million. Fuel imports, $90 million. Food imports, $60 million. Machinery and medicine, $80 million. Total outflows, $410 million. Remaining for schools, hospitals, roads for 10 million people, $40 million, $4 per person for an entire year. Impossible. So Zambia borrows more from the IMF. In dollars, fast forward to 2015, copper prices crash. Zambia now exports double the volume just to get the same dollars, double the extraction, double the environmental damage. For dollars that immediately flow out, the country is mining itself into poverty. And the cruelest part, the more Zambia exports, the more copper floods global markets. More supply means lower prices, which means Zambia exports even more. Death spiral. Not from bad governance, from the structure of dollar dependence. Why can't Zambia just use its own currency? Because no one wants kwacha outside Zambia's borders. India says, what will we do with kwacha? We can't buy anything with it. We need dollars or rupees. Only the dollar is universally accepted. Because America is the largest economy, everyone trusts dollars will hold value everywhere. This gives the United States an extraordinary privilege: print money to pay for imports. When America wants oil, it pays in dollars it creates with a keystroke. When Zambia wants oil, It mines copper, ships it abroad, sells it for dollars, then uses those dollars to buy oil. America trades paper for resources. Zambia trades resources for paper to trade for other resources. This asymmetry is the core of the trap. Valéry Giscard d'Estaing, former French president, called it America's exorbitant privilege, the ability to consume more than you produce, forever, because the world needs your currency. It's darker. Developing countries don't just need dollars for trade, they need dollar reserves to prevent currency collapse. When investors panic and pull money out, capital flight central banks burn through dollar reserves trying to stabilize the currency. If reserves run out, the currency collapses, imports become unaffordable, inflation explodes, the economy implodes. To prevent this, countries hoard dollar reserves, which means exporting more than they import, sending real goods abroad in exchange for dollars they can't spend, working overtime and locking all earnings in a safe you can never open, just to prove you could pay rent if demanded. China, $3.2 trillion in dollar reserves. Japan, $1.3 trillion. India, $600 billion. Over $5 trillion in real goods and labor exported to the West in exchange for dollars they're forced to hoard. It's the largest wealth transfer in human history. Invisible because it looks like responsible financial management. But here's the number that should make you pause. For every dollar in foreign aid flowing into Africa, $3 flow out through debt payments and capital flight. The continent isn't being helped. It's being drained. Don't countries just refuse? Stop using dollars? Some tried. Iraq, 2000. Saddam Hussein announces Iraq will sell oil in euros instead of dollars. Oil revenues drop, banks freeze Iraqi accounts, sanctions tighten. Then, 2003, the U.S. invades. Saddam is overthrown. First act of the new government, switch oil sales back to dollars. Libya, 2009. Muammar Gaddafi proposes a gold-backed African currency to replace the dollar in African trade. The plan gains traction. Then, 2011, NATO intervenes. Gaddafi is killed. The currency plan dies with him. Hillary Clinton's leaked emails reveal France's motivation, preventing Gaddafi's currency from threatening French control over African monetary policy. Iran, Venezuela, Russia, all attempted to reduce dollar dependence, all face sanctions, isolation, economic warfare. The message: you can opt out, but you'll be destroyed for trying. Because dollar dominance isn't just economic, it's enforced by sanctions, by SWIFT, the banking system that processes dollar transactions, by military power when necessary. Rejecting the dollar means rejecting access to global finance. For most countries, that's a death sentence. If you obey the rules, the trap still gets you. Argentina, rich in resources, fertile land, oil, lithium, educated population. 9 sovereign debt defaults, 200% annual inflation. Peso collapsed repeatedly. Why? The dollar trap. Argentina imports fuel, machinery, medicine priced in dollars. When the peso weakens, imports cost more. Inflation rises. To fight inflation, the central bank raises interest rates. High rates attract foreign investment. Dollars flow in. But it's hot money. Speculative capital. The moment there's trouble, investors flee. Convert pesos to dollars and exit. Capital flight, peso collapses, reserves evaporate, inflation explodes. Argentina borrows from the IMF to stabilize. But loans come with conditions: austerity, cut spending, raise taxes, open markets. Austerity deepens recession, unemployment rises, tax revenue falls, deficit grows, which means more borrowing, more austerity, deeper recession. Doom loop. 9 times since 1950. An IMF official speaking off the record in 2018. We're not here to be popular. We're here to ensure debt repayment. If that requires painful reforms, so be it. Not incompetence, not even cruelty, just the system functioning as designed. The most insidious part. The dollar trap makes corruption inevitable. When you're desperate for dollars, officials take shortcuts. Sell resource rights for upfront dollar payments, accept bribes in dollars, stash money offshore, because dollars are the only currency that holds value internationally. The only currency you can use if you need to flee. So elites don't invest locally. They extract value, convert to dollars, move it offshore. Swiss banks, London real estate, New York penthouses. Capital flight, rational for individuals, devastating for countries. Nigeria loses $15 billion annually to capital flight. South Africa loses $10 billion. Dollars earned from exports, immediately funneled abroad by elites. It's not just corruption, it's survival. In a dollar trap, the rational move is get dollars and get them out. When everyone does the rational thing, the country collapses. Their escape? China did it. But it took 30 years of authoritarian control and brutal sacrifice. China kept its currency artificially cheap, forced foreign companies to share technology, built reserves by running massive trade surpluses. For 3 decades, Chinese workers produced goods for the world while living in relative poverty. The country accumulated $3 trillion. Only then could it allow wages to rise. It worked. But it required political control democracies can't sustain, and decades of worker exploitation. South Korea escaped with massive American Cold War support. That geopolitical exception doesn't exist anymore. For most countries, escape is impossible. Stop needing imports. You need machinery to build industry. Machinery requires dollars. You can't build the ladder to climb out of the hole. What happens when countries try? Iran, 2012. U.S. sanctions cut Iran from the dollar system. Iran adapts, barters oil for goods, no dollars. But barter is inefficient. Iran accepts lower prices just to move oil. Can't import medicine, pharmaceutical companies won't barter. Critical drugs become unavailable. People die. The rial collapses from 12,000 per dollar to 42,000 inches 2 years. Eventually Iran caves, negotiates nuclear limits for partial sanctions relief, partial access back to dollars. Russia tried to reduce dollar dependence since 2014. Accumulated gold, built alternative payment systems. When cut from SWIFT in 2022, the ruble crashed 30% in days. The trap holds, even for large, resource-rich countries. For smaller nations, escape is fantasy. What this means in human terms. Kenya, a farmer grows premium coffee beans, worth $3 per pound in Nairobi. That coffee reaches European stores at $20 per pound. The farmer gets $3 in shillings that lose value to inflation immediately. The international supply chain exporters, shippers, roasters, retailers extract $17 in value, all denominated in dollars. The farmer can't accumulate wealth, can't buy better equipment, can't afford university for his kids. Meanwhile, Kenya imports fertilizer for that farm, priced in dollars. When the shilling weakens, fertilizer becomes unaffordable. Yields fall. Farmer earns even less. Not poverty from laziness. Structural extraction. The dollar system functioning as designed. And here's the part that connects to you. The cobalt in your phone was mined by Congolese workers earning $2 per day. The phone costs $1,000. That $998 difference, extracted through the dollar trap at every step of the supply chain. Across Africa, Asia, Latin America, billions work, produce real value, extract resources, and watch that value flow out in dollars to pay for imports, debt service, and capital flight. They're not building wealth. They're fueling someone else's economy. Developing countries owe $9 trillion in external debt, most denominated in dollars. When borrowed, the dollar was weak. Debt seemed manageable. But when the dollar strengthens, the debt becomes more expensive in local currency terms. Zambia borrowed $3 billion when the kwacha was 10 to the dollar. Now the kwacha is 20 to the dollar. That debt costs twice as much locally, even though the dollar amount hasn't changed. Entire national budgets consumed by debt service. Nothing left for schools or hospitals. When countries can't pay, they restructure. Creditors extend timelines or reduce rates, but only for reforms. Privatization, market opening, loss of sovereignty. Zambia privatized copper mines in the 1,990 seconds under IMF pressure. Foreign companies now extract copper. Profits flow abroad in dollars. Zambia gets small royalties. The resource remains. The wealth leaves. Ghana's gold, Nigeria's oil, Bolivia's lithium. Same pattern everywhere. Sell resource rights for immediate dollars to pay debt. Watch foreign companies extract wealth forever. Not development, asset stripping. Doesn't this spark revolution? Because the trap is invisible. If foreign troops occupied your country and demanded tribute, you'd resist. But when extraction happens through interest rates, exchange rates, and commodity prices, it looks like economics, natural forces. The IMF official isn't an invader. They're a technocrat offering loans. The conditions that strip sovereignty aren't discussed in those terms. The foreign mining company isn't a colonizer. They're an investor bringing jobs. The fact they extract far more value than they provide isn't calculated. The system operates under language of free trade, market efficiency, mutual benefit. But the outcome is identical to colonialism. Wealth flows from poor countries to rich ones. Resources extracted. Profits repatriated. The only difference is mechanism. No need for armies when debt and dollar dependence do the work. Final twist. The countries that benefit most created the trap. The United States runs a $1 trillion annual trade deficit, buys more than it sells, consumes more than it produces, because the world needs dollars. So the world sends real goods to America, In exchange for dollars, America creates freely. American consumers get cheap electronics from China, cheap clothes from Bangladesh, cheap coffee from Kenya, paid for with printed dollars. Those dollars flow abroad, but they come back. Foreign governments use them to buy U.S. Treasury bonds, lending the money back to America. America gets the goods and gets the money back as loans. It rolls over indefinitely. For everyone else, it's a trap. For America, it's a printing press for prosperity. As long as the dollar remains the reserve currency, this continues. And the dollar remains reserve currency because there's no alternative. The euro is fragmented, the yuan is controlled, gold is scarce. The trap persists. The term in economics, resource curse. Countries rich in oil or minerals often end up poorer than countries with no resources. Economists blame corruption or weak institutions. But the real curse is the dollar trap. Resources are priced in dollars. To sell them, you enter the dollar system. Once in, you can't escape. You become dependent on commodity exports. Can't develop other industries because you lack dollars to import machinery. Locked into being a resource exporter. Forever. Meanwhile, resource-poor countries like Singapore had to industrialize. They had no choice. So they built manufacturing, developed technology, created value-added goods. Harder, but the only way out. The resource curse isn't about having resources. It's about the trap resources create in a dollar-dominated system. The dollar system is showing cracks. China pushes the yuan. Russia builds alternative payment systems. But replacing the dollar requires trust built over decades. The dollar has been reserve currency for 80 years. Contracts denominated in dollars, debts owed in dollars, reserves held in dollars. Unwinding without chaos is nearly impossible. Most likely, the trap continues. Maybe with the yuan sharing burden. But for poor countries, nothing fundamental changes. They'll still mine copper, pump oil, grow coffee, still watch value flow out in whatever currency replaces the dollar, because the trap isn't about the dollar. It's about global trade structure that privileges currency issuers over goods producers. That won't change without revolution in how we think about money, trade, and value. What can you do? If you live in a rich country, understand your prosperity is built partly on this system. The cheap goods filling your home aren't accidents. They're features of the dollar trap. Someone, somewhere, is working for $2 a day so you can buy a $1,000 phone. If you live in a poor country, understand your poverty isn't just bad governance. It's structural. The system is designed to extract, not develop. You can't vote your way out, can't export your way out. More exports just mean more extraction. The only way out is stop needing dollars. Build domestic supply chains, develop regional currencies, reduce commodity dependence. But that requires decades of sacrifice. Political will democracies struggle to maintain. Possible, but at enormous cost. The dollar trap isn't conspiracy. It's a system, built at Bretton Woods, enforced by sanctions and markets, maintained because there's no alternative. A country discovers oil. The money arrives. 10 years later, they're broke. Not because the money disappeared. Because it was never theirs to keep. It was always going to flow through. Dollars in, dollars out. The country just a pipeline for extraction. The oil gets pumped, the copper gets mined, the coffee gets grown, and somewhere else, someone uses those resources while barely paying for them, because they have the printing press. And you don't. History doesn't repeat. It reveals. The world economy isn't a marketplace. It's a mechanism. And that mechanism has winners and losers built into design. You were never meant to escape. You were meant to produce. Welcome to the treadmill. Now you know why it never stops.